Wouldn't it be nice if we could make 100K per year passive income and we can sit on a beach in Bali, just relax and do whatever else we like? Well, that's the dream that most people have, and that's the number one reason people have strategy sessions with me. How do I build a portfolio or a machine to then generate me passive income as well as capital growth long term? So that stuff can compound in the background while I enjoy, kick back and sip on pina coladas. So in this video, we're gonna break down how exactly you do that with real estate and how you do have other assets to actually focus on, like your crypto and your ETFs and shares. So if you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, if you are interested in more daily updates, Patreon, that's where I am every single day. On this channel, I bring about 2 to 3 videos, and if I'm not here, I'm on the NFT channel. So definitely go subscribe to that. I'll leave a link up here. So in a second here, we're gonna jump into my trusty whiteboard, which is my iPad, and we're gonna go through some whiteboard finance to understand how exactly is it possible to go and build a portfolio that can generate $100,000 per year in passive income. So let's jump in. Now, I'm not oblivious to the fact that you can do this in other ways. One of those would be ETFs. Now, I'm personally not a fan, and I'm gonna leave a video up here as to why I'm not, but you may be looking at this financial instrument as a long-term option. The other option you have is crypto, and I know a lot of people sort of stay away from crypto because it's so volatile, but we are looking long-term here. So just remember that. And then in this video, we're going to be focusing on the real estate component. Now, before we jump into the real estate stuff, it's important to understand ETFs, shares, and crypto and how you can actually go with the 4% rule and actually retire with these assets. So I'm going to spend some time here and then we'll jump into the real nitty-gritty numbers that I know you're here for. So with ETFs and crypto, you have the potential to leverage. Now, yes, you can take out margin loans. Yes, you can take loans against your crypto, but the risk is a lot higher relative to, say, something like property. Reason being is that they can go into liquidations. Let's say you've taken out a loan against your shares or against your portfolio in crypto. If the value of that crypto goes down or your shares go down, then they might be liquidated. So you lose everything. And that's why some people avoid having to go down this path. Now, there are options out there, but again, we're focusing on the real estate stuff, but it's just important to know that there are options there. Now, when you look at the 4% rule and you're staking at 4%, whether it's crypto or whether you're getting dividends from ETFs, that usually means that if I have, say, $1 million, right, and I get that at 4%, then that means I'm generating $40,000 per year. So obviously, if we're trying to generate $100,000, you work backwards and you need to figure out how much do you need to have in your share portfolio, in your crypto portfolio to generate $100,000. And if you look at 2 million at 4%, that means it's $80,000. You would need a portfolio of $2.5 million to then be able to generate $100,000 per year. Now, to get to $2.5 million is not an easy task, especially when you're not using leverage. That's why I don't look at this alone as financial instruments to get me to financial freedom. You can definitely use this as part of your entire portfolio, you can diversify, but I like to build my foundation on real estate, and I'm going to show you why. So with real estate, you need leverage. So something that holds a lot of people back is having the ability to get a loan. If you aren't able to get a loan from a bank, well then real estate, to be honest, it doesn't really work out. You want to use the leverage gains to really take advantage of real estate. Otherwise, you're then forking out a large amount of money for just one asset. Now you're getting into risk management and diversifying, so this comes down to you and your strategy. With real estate, you get both capital growth and you get cash flow. Now, if we look at just the cash flow component, because that's what we were doing with ETFs and crypto, is that in a capital city, you're probably looking at about 4% rental yield. So gross rental yield, we haven't taken into account all of your expenses, but that's usually the cash flow. If you're looking regionally, you're looking at about 5 to 6%, and it depends on where you're looking. Now, again, we're not just focusing on cash flow. We need the capital growth. Otherwise, this whole thing doesn't work. You need both. Equally, if you go down the capital city point of view and you earn 3 to 4%, the cash flow alone is not enough for the bank to give you more loans. So it's just something important to keep in mind. Now, if you look at commercial, I know some of you guys are interested in the commercial stuff. Yes, you're looking at a higher cash flow, but in order to get into commercial, you're usually looking at a 30% deposit. If you're looking at $1 million asset, you would need to put in $300,000 to obtain that as a deposit. If you were looking at the same property residential, whether it's capital city or regional, you're probably looking at anywhere from a 20% deposit all the way down to a 10% deposit. So that could definitely mean you're leveraging a lot more if you have smaller deposits. Hence why I don't like the commercial stuff. Now let's start breaking down some numbers. So this is property 1. And this property is for $350,000. Now, these numbers that I've worked out is on a previous deal that we just did, so that you get an idea of what you can really obtain out there. Now, I know some of you guys might be sitting in Sydney, even Queensland and in Melbourne, and you're thinking,
where the hell am I going to find a property for 350K?
And that is the beauty of Australia. You need to be a borderless investor. It seems like it's a non-negotiable nowadays. If you're looking at real estate, you need to look at other states. You need to go out there and research different areas. And the ideal portfolio, to be honest, is like having one in every state, so that when things are happening and the market's moving, you don't have the entire Australian property market move together. That's just one generalized market. What you're looking for is when certain areas are moving, you're able to take out that equity, go into areas that have bottomed out, and then you can reverse that process when things turn around in the property clock. So $350,000 is your purchase price, and it rents for $380 per week. Now, what we're doing is we're basing this on an interest rate of 3% at interest only. I've spoken about this in detail, interest only versus interest plus principal. I'll leave a video up here so you can definitely check that out. Now here, the other expenses you will also have is about $5,000 per year. Now, what does that include? Well, it could include your council rates, water rates, insurances, and some monies there for your property management fees, as well as repairs and maintenance. So that's $5,000 there. Now, if you take out an 88% LVR loan, which basically means 12% is what you're putting in from your pocket as a deposit, 88% is what the bank's giving you. So if you go with that, that means $308,000 is your entire loan. So just to recap, $350,000 is the property you're purchasing it for. It rents for $380 per week, but the actual loan is for $308,000. That is 88% of the entire value, which is $350K. Now, yearly outgoings, obviously you've got your loan repayments. Now, this is based on the 3% interest only repayments. This is $9,240. The other expenses is $5,000, which we've just taken up from there. And this would mean that your total outgoing is $14,240. Your yearly rent is just 380 times 52. That gives you 19,760. That means your cash flow is this number here minus this number, which gives you $5,520 positive cash flow every year. Now, let's just take a second here. I know there's not a lot of numbers being thrown. I'll take it step by step. $5,520 positive cash flow means you get to hold the property, because you need to pay your loan repayments, you need to pay your mortgage, you need to pay your other expenses. So you're holding the property. But the rent that comes in is covering all of the expenses to hold this property. So guess what? If you lose your job tomorrow, do you lose the house? No. And this is the point I try and make through my videos, is that just because you want to try and save some money in tax, just because you're trying to avoid buying an investment property, get some grants and buy your own house, you are putting yourself at risk. Now, given the market is at a point where it could go either way, it's a toss of a coin, is that why would I want to be taking on that sort of risk when I can just go down this path and I go and hold an investment property in a good location? And the next question you might have is,
Ravi, that's great, but what happens if you lose your tenant?
That is why you look at research and going into the right areas, because the vacancy rates will be low, the demand is higher to go and rent there, and because most people are priced out of that market, they have to look at renting as an alternative. So in that case, your rents actually go up as well during times like this. If you're simply getting $5,520 per year, well, in order to get to 100K, all you need to do is buy 18 properties at 350K.
If that's all you wanted to watch, take it easy, relax, and go and buy 18 properties.
Look, we know that 18 properties sounds absurd, and it is, because most people won't be able to get a loan of 6.3 million. Now, when I say most people, like 99.99% of people won't be able to do this. Is there another way? Yes, there is. Let's keep watching. Now, that example of 18 properties is if you bought 18 today, you would have 100K coming into your pocket and you could retire. Basically, that's it. Your properties grow in value, you're done. But if we looked at another situation, is that once we've paid off this house, now that could take 25 years, but once we've paid it off, you then don't have to pay your repayments on your loan because you don't have a loan anymore. That means that we are now making $14,760 from this property. Now, again, we're basing this on today's terms. We're not counting for inflation. We're not looking at rental increases. We're just looking at what it would look like today. Now, if we were to use that amount, that means we would need 7 properties completely paid off to then be generating us 100K a year, and our portfolio would be worth $2.45 million. Now, just on that example alone, if you were to go out there and you're building a portfolio base, you build a foundation like this, means that in 25 years, you can officially retire. Now, yes, a lot of people may come out and say, well, interest rates could go up, inflation's higher than normal. We're not preparing for those things. Well, we're not taking into account those things in this example. Yes, interest rates will go up. They could go up, they could also go down. Yes, we could have increases in rentals, but they could also go down. And inflation may not be a problem in 10 years, depending on what they do with interest rates. So there's a lot of factors that come later. But this is to give us an idea that, hey, we've got a bit of a roadmap. We know where we're going with this vision. As you go, you need to adapt. This is not a set and forget. And to be honest, anyone that goes out there, purchases ETFs, shares, crypto, or real estate, if you're approaching this saying, oh, I just want to set and forget, like I don't want to ever have to look at it again, I'll buy today and I'll look at it in 25 years, you're doing it wrong. Because the market changes, the economy changes, you need to adapt, otherwise you get left behind. Imagine if you were invested in a company, you go and buy their shares, and then all of a sudden you have something like disruptive technology come around and they take over that business. And because if you had taken that approach of saying,
I'm never going to look at this and I'm just going to continue buying,
you may not realize that that company is not relevant anymore. You're now bleeding and losing money. So please pay attention. It's a regular health check that you need to be doing on your portfolio anyway. Now, in this example, we're obviously saying that you're going to pay off your loans and that'll be in 25 years. So you're going, well, I came here to try and retire in 10 years, but you're telling me it's not possible until another 25. Well, there is another solution. Keep watching. The solution is I cannot give you financial advice. So I'm going to tell you what I would personally be doing in this scenario. I would go and actually purchase 10 properties. Instead of the 7, because I know 7 will get me to my number, I'm going to go and purchase 10, which is plus 3 what I needed. Now, I would hold that for 10 years. So again, we're saying, well, it's a 10-year plan. Guys, you're signing up for like 40 years to work at your job. 10 years is freaking brilliant. 25 years, I would go on to argue, is amazing to be self-retired. It's just about thinking earlier. When you're young, you're not thinking about these things. And I'm so glad I started thinking about this in my early 20s. I'm now 29 and I've got a portfolio. The same conversations I'm having with clients, 25, 35, 45, I'm saying you guys are still early. Still young enough to make a change, because I'm telling you, when you get to 55 and you get to 60, I've seen plenty of people, I've talked to many people in strategy sessions, and their hands are tied. Now they have to take higher risk if they want to not rely on the pension or anything else. So if I go in and I purchase 10 properties, I'm going to hold that for 10 years. I can then sell 3 properties, use the profits to then pay down my debt quicker. Now, I've got a video here on this channel and I'll link it up here, which actually discusses some of the ways that you can pay down your debt a lot quicker. It's the accelerator method. And this means that you can go in, compound the growth, but also reduce your debt. I'm not oblivious to the fact that I don't want to be carrying so much debt and people don't like it. I understand that. I don't have intentions to hold my debt forever. Although debt during inflationary times could be deemed as an asset, it might be the peace of mind that you really need. So there are ways to do it. You should definitely go check out that video. Now, in this example, you could probably then retire in 10 to 15 years with 100K per year. Now, something that I'm personally doing, and is something that you could ultimately look at, but it comes with a disclaimer. It is higher risk. You need to understand your risk appetite. You need to understand what your foundation looks like. And again, that's why I'm not a financial advisor. But in my case, what I'm doing is, yes, I've got the property, which is traditional real estate. This is the stuff that sort of just, plugs away, giving me the cash flow, gives me the capital growth, and over time it works out. Now, while I do that, I'm also coupling that with what I can do in disruptive technology, being crypto. Cryptocurrency, blockchain technology is here to stay. It doesn't matter what your personal opinion is. It doesn't matter what my personal opinion is. It's what the market is dictating. That is what's happening. So when you go down this path, I've got here a little Bitcoin there, and that means that I've got a plan here of 6 years that I can retire with what my goals are. Now, your goals are different to mine. You may not want to retire in 6 years. Now, I could argue that I'm already generating about 100K per year passively through my investments. I'm retired now, but I also could argue that I retired about 4 years ago when I started doing things I love. Now, the key is that this is a video, so you can go back, you can look through it, you can look at the example and see how you can multiply it, also adjust your own strategy. If you need a hand with your strategy, definitely go down. There's a link in the description below where you can actually book a strategy session. If there's not one available, because they do get booked out very quickly, the first chance that you have is going and joining the Patreon group, because that's where I release them before I release them publicly. The process can be done in numerous ways. You can use different financial instruments, but the idea is the same. You're using these instruments, not being emotional about them, be very logical, be very focused, and have the long-term view. If you're looking at something like flipping in 2-3 years and then retiring, you need to figure out why you're so desperate to retire. That's probably a better question to ask rather than why can't I retire in 2 to 3 years, as to why are you planning to retire in 2 to 3 years. If you have enjoyed this video, definitely drop a like and share this with someone that really needs it, because then the YouTube algorithm picks it up. And you know what happens when the YouTube algorithm picks it up? We just have a community of more smarter people, and that's all we need. If you have enjoyed this, definitely subscribe, and I'll catch you guys in the next one. Thanks, guys.